I'm an active angel investor. I've been investing for about 3 years. And the person who's responsible for me becoming an angel investor is actually in the room. So Stus Question, thank you very much. I went to him one day and said I was tired of bumping into the arrogance of science. What, somebody laughed? What'd you say?
I take no responsibility.
I'm very appreciative. I call you out all the time in a positive way. Stu and I learned how to fly helicopters together about 10 years ago, and I got my commercial rating about 3 years ago because, you know, a girl has to have a hobby. And, you know, the bar is a little bit higher for us women. So I went to him and I said, I'm tired of the arrogance of science within biotech, med device, diagnostic, and digital health, not appreciating technology. And my value proposition is leveraging technology to improve business processes and get companies to market faster. Well, within biotech, being a business person who understands technology, it wasn't really appreciated. And so Stu suggested that I go into angel investing, at which point I didn't know that it was even something that was available to me. So now I actively try to recruit more women to become angel investors, to invest for so many different reasons. But I will be forever in Stu's debt because of that. So I've invested in about 9 startups over the last 3 years. I jumped right into Sandhill Angels. My experience at Sandhill was pretty dreadful as a woman, but it was an awesome, awesome training ground. And within a year, I was on the board. A year and a half, I was vice president. Last year, I was vice president responsible for deal sourcing and saw between 250 and 500 deals a month. Now, keep in mind, I still consult full-time for biotech, med device, diagnostic, and digital health companies. And Stu also got me into being an expert witness, so I do expert witness work within technology as well. And no, I do not sleep. And this is me not on caffeine. So I live here in Redwood City, which is a perfect place to see a lot, but I also spend a lot of time looking outside because it's very easy to be very myopic and think that innovation only happens here. And I think innovation happens everywhere. So I just spent 2 weeks in Europe between Paris, Tallinn, Berlin, and Nice, seeing what was going on in the ecosystem. And I've also been to Slush twice. To see what's going on in the Nordics, because digital health is the things that are happening within digital health within the Nordics is absolutely amazing. So the reason why I'm kind of giving you some perspective, the other thing is my average check size is about $10,000 to $15,000, so it's not very big, but I tend to double and triple down. So some of my investments, my health teams, I've doubled down, Sandstone, tripled down, Zoom, which is on-demand and scheduled rides for kids 5 and over. Anybody familiar with Zoom? That one's doing really, really well. Yeah, female CEO, co-founder. Tomboy X, I've tripled down. Tuio's only come around once. Tactical haptics I don't like, so I don't talk about that one. And Astarte Medical is a brand new one in the pediatech space. So I focus on investing in femtech and pediatech, so women's health and children's health, because I see a huge opportunity there, and my experience in life sciences, I think, lends itself really well to that. When I first invested in my health teams, I did no due diligence. I wrote a check. It was the first month I was angel investing. I said, this needs to exist in the world. I love what they're doing. It all seems to make sense, and my gut said, go for it. No due diligence. Second one was Sandstone Diagnostic, which was the next month. No due diligence. Just needed to exist in the world. Sandstone is a home sperm count kit, and it's a digital health platform for men because semen or sperm is a good indicator of men's health. I love this company. I think men need this because men don't focus enough on their health. No due diligence. Tuio Health, I was leading the deal within Sandhill Angels, and I did a ton of due diligence, which I'm going to run through right now. Astarte, I did some more. My latest investment, which hasn't gone through, is Senderide, and I did a ton because I tried to syndicate it on AngelList. I was unsuccessful. Senderide is concierge level rides, non-emergency medical rides, and rides for the elderly. They're out of Oklahoma City. Astarte is out of Philadelphia. I've been priced out of the Bay Area pretty much with valuations, and so I'm looking outside the Bay Area. But for all of my different investments, I did different levels of due diligence. And the thing that's important as founders for you to understand, and those of you who've gone through it, it's all over the board. Everybody has different things that they're looking at. Some people, and I'm talking angels, I'm not talking venture. Venture is a completely different ballgame. For those of us who are investing our own money, Some people do a lot, some people do a little, some people focus on things that they're super comfortable with. Like I know Stu, he does IP related stuff. He focuses on IP. I know nothing about that. So I generally don't invest in companies that have strong, have patent related stuff because it's really outside of my wheelhouse and it's not an area that I focus on. If I invest in something that has a regulatory piece to it, I spend a lot of time looking at the regulatory. So why do we do, let me see if I've got, why do we do it? What are we looking for and what should you prepare for? Why do we do it? We do it to understand our risk. And some investors like me look for reasons to support our investment. We're not necessarily looking, we've already made our decisions and we're just looking for those wild card things that could potentially send it sideways and see if we want to do something different. But everybody's different. So in terms of what to be prepared for, I actually have a checklist, which I think you're going to, if you respond to the survey and say fabulous things, you get a copy of it. If you don't want to, I actually put a Medium post out today, but it doesn't show what's required and what's optional. But it's 1, 2, 3. It's like 5 pages long, and it goes through all the different areas that I may focus on depending upon the investment. But I ascribe to what Jason Calacanis said like 3 years ago when I got into angel investing, which is right size your due diligence to the size of your check and the size of your round. If I'm putting $10,000, which is significant for some people, but it's not really significant for me, how much time am I going to want to spend to invest $10,000? Not a ton of time. How much am I going to want to spend with my attorney to take a look at documents to potentially not change my mind? $600 an hour, I'm not going to spend a whole heck of a lot because that's potentially money that I can be investing in another startup. This is my perspective. I don't know about other investors, but this is the way that I approach it. I am a firm believer in right-sizing everything that we do, whether it's compliance-related stuff with the FDA, SOX-related stuff from a finance perspective, right-sizing due diligence. I believe in right-sizing stuff to certain criteria. So I think that's all I want to cover on that. In terms of what to be prepared for, the other thing is, depending upon the investor and their level of sophistication, their experience, and their risk tolerance, all of those things are going to drive what they look for. I actually had a founder who was driven nuts by somebody who was going to write like a $10,000 or $15,000 check, and every week for like 8 weeks, she was getting these nitpicky little questions. And at one point, I just said, "Why are you even responding to them at this point?" Because obviously they're looking for a reason to say no. They're not looking for a reason to say yes, and you're just wasting your time. So, and of course, she's Southern, so she can graciously get out of it. But at some point, because not all investors are the same, you kind of have to take a look. And this is one of the things I'll talk about in terms of you doing your own due diligence on investors, because not all money is the same and not all investors are the same. So it's not just us as investors who are the ones who are supposed to be doing the due diligence. You can't be prepared for everything, but having a solid foundation helps. So for those of you who have opened deal rooms, what have you used? Carta, Google Docs, Box, Dropbox, anything else? Zambato. I'm sorry? Zambato. Oh, I haven't even heard of that one. You're going to have to. Zambato. Here, I get to take notes too. Zambato. Do you like it? I do. Okay. Oh, there we have a new one. Zambato. Okay, I'll add that to it. The important thing is to keep track of who you've given access to your deal room so that you can then withdraw access depending upon the credentialing. You don't want that sitting out there forever associated with it. So what I look for generally, as I said, depends on my check size. I have 5 different areas. I look at the deal. I look at financials, corporate, IP and technology, to some extent. Product marketing, sales, and manufacturing information. So some of these areas I will dig into deeper depending upon the startup. So if there's like Astarte, I just wrote a check for it to them. I looked at their purchasing agreement. I looked at all the supporting stuff. I cross-checked some of the stuff that was in their deal room to make sure that it matched what was in the deck. I cannot tell you how many times something will be pitched in the deck and then it won't match in the diligence information, and I'll ask about it, and there won't be a good answer. That is not good signal. So one of the other things to think about with the due diligence process is it's your opportunity to build a good relationship with your investor, to show them your thought process, how responsive you are, and give them support for their investment. Help them build their case for investing in your company. Make it easy. Usually if I'm doing a full due diligence, I'll wait until everything's in. I'll open up a bottle of wine and, and I'll start digging through stuff. And because I negotiate a lot of contracts for all of my clients, I see a lot of agreements. And so I will spend time on the agreements and take a close look at those. And then depending upon what it is, if it's pre-revenue, I won't check in any customer references. But if it's post-revenue, I will check to make sure the customers actually exist and they're not pilots that are wannabe customers. I had a case where somebody said that they had paying customers. Turned out they were pilots. They weren't paying. So that's usually not a good signal. That was hard for them to be able to explain. It did not invest in that one. I'll take a look at, as I said, if I'm syndicating, I'll feel like I have a greater fiduciary responsibility, so I'll do a deeper dive. Like with Send a Ride, which I was not able to syndicate, but I invested in, I looked through everything. Cross-checked everything, checked with some customers, and in other cases, like I said, with Astarte, I looked at the terms. They were doing Keiretsu. I don't know if anybody's familiar with Keiretsu, so I skimmed through their due diligence package. I'm like, well, it's there. I may as well take a look at it. I looked at the financial projections. And the reason why I looked at the financial projections is I wanted to cross-check where they thought they were going to be and cross-check it against what they put in the deck in terms of revenue projections and how quickly they thought they were going to grow and how much money they thought they were going to need. I just needed to make sure that they were asking for enough money that was going to get them to meet the milestones they said they were going to meet. So I do a lot of sanity checking to make sure that what they're saying is reasonable and rational. If you have a company, I'll use a drug company for example. I don't invest in drug. I just consult and make money off of them instead. The drug companies, if somebody says we need $5 million to get to regulatory approval and we're going to do it in 2 years, it costs between $161 million and $2.4 billion to get a drug to market, and its average is 7 to 12 years. So that doesn't fly. So I'm usually sanity checking for something. Or if it's a digital health company, I'll ask what the regulatory strategy is. If they'll say, I don't know, or we don't have to worry about a regulatory strategy, and I'll look at them, I'm like, have you talked to anybody? What kind of health claims are you planning on making? What's going to be your go-to-market strategy? And if it's a tech person who has no experience in the space, that's usually a bad signal. But usually I know about this before I even go into due diligence. I say that dating is like the pitch and the conversations that you have before you go into due diligence. And due diligence is when you're essentially engaged and you're really trying to make sure before you get married in your 7 to 10, 12-year relationship with your investor, which is the wedding when you sign all of your documents or your agreements. And I think there are statistics that say that an investment lasts longer than most marriages now. So something to keep in mind. So those are the 5 areas that I will take a look at. So with the deal. And these slides are going to be really simple, but as I said, I have a checklist that you can get access to. And I mean, I can't remember all these things. Some of them are required. Some of them are going to be optional, and it's all going to be tailored to the specific deal, how well I know the founders and how much experience I have in this space. I generally don't invest in spaces I don't have experience in. When I first started angel investing, I did a wide net, and I went after, oh my gosh, I went after everything. And then I've narrowed it down just because this is a part-time thing at 30, 40 hours a week. I can't be an expert in everything, and that I can't be a good investor if I don't have a clue about what it is that I'm doing. So, so in terms of the deal, what's the request, the milestones to achieve, the terms, is it a convertible note, is it a priced round? I don't invest in safes. I know other people do, but I don't. That's usually the quickest way to kill a deal with me. So if there's a term sheet, I'll take a look at the terms in the term sheet. The list of the other investors in the particular round, I'd like to see who else I'm playing with. Personally, I don't need big name investors because chances are when I'm looking to invest in, they're not necessarily paying attention to, and it's also early stage. So I don't need that. I know other people who tend to follow. I'm a terrible follower. Other followers do like to see that. And Zach Colias at Angel Summit just 2 weeks ago talked about those people on AngelList who invest want to see social proof, and they want to have a big name investor who's investing before they follow. So that's where I went wrong on the syndicate, because they're out of Oklahoma. I mean, they don't have a big name person. And then if there's any sort of dilution modeling, I'll take a look at that. I did not know what this was until I took the online venture deals class that Brad Feld and Jason Mendelson put on. If this comes back around, it is like a 6 or 7 week online class. It's free. It's amazing, because all of my training has really been on the job and learning from various different people that I've invested along with, or the podcasts I've listened to and the things that I've read. And Angel, the book, is I highly, highly recommend that. This filled in a lot of the gaps for things that I didn't previously understand. I don't come from a VC background. I don't come from a banking background. So Christina, coming from her banking background, has a much better platform to work from a foundational perspective than I do, coming in having worked in life sciences and consulting, running my own business for 13 years. Yeah.
What was it that you mentioned?
So it's venture deals. And so they do it along with Kauffman Fellows. It's a lot of work. If you want to get something out of it, it's not 2 to 3 hours. There was one day I spent 8 hours on the first project, and it's team stuff. I did a lot of stuff for our team, but I don't care. I got a lot of it. I loved it. Loved it. So anyway, so now I understand dilution modeling much better, and cross-checking against the pitch. As I'm going through and I'm reviewing, I'm creating a whole list of questions. And sometimes I'll send them over piecemeal, and sometimes I'll create a whole list, and there'll be 30 questions that I'll go over to the founder. One of the things I'm looking for as an investor is how quickly are they responding, and what's the quality of the responses. I had one particular founder. It was a deal I was leading through Sandhill. I wasn't going to invest. I think it was a drone company or something. I told you I cast a wide net. He was so dismissive in his responses. I was like, I can't even recommend this. If he's blowing off my diligence questions, what's it going to be like when things start to go sideways? I mean, they were good questions. It's not like they were crappy questions. And as I said, it's an opportunity to continue to build the relationship, because some of the early stage investors, for me, my check isn't very big. But as Haas said, I know a lot of people. The connections that I have are not some mainstream connections, but I do have a global network. And I am super happy in making introductions, social media, helping vet new hires. I put in time, so you could potentially find an investor who may not write a big check, but may be really, really valuable in other ways. So just keep that in mind. Financial matters. I typically like to take questions as we go along, but I'm going to respect this format, and we're just going to go through, so hopefully you'll remember better than I do. I want to understand the financial situation for the company. I want to know where you've been. If you are an early stage company, you've raised no money, it's your first pre-seed round, wherever it is on the scale these days, and you're doing audited financial statements, I'm going to wonder why. I'm like, it just seems, people understand the difference between compilation review and audits, kind of. Audits are just a shit ton more work. Sorry, I'm not going to swear. So a compilation for an early stage company should be sufficient. A review, most people don't do reviews anymore, and so audits. Usually what happens later on is an investor may require it. But let's say you get an early stage investor who puts in $50,000 and then requires audited financial statements. That's unreasonable. It's absolutely. So I sanity check as I'm going through. I want to see your financial projections, understand the management team, who your advisors are, any sort of agreements, understanding what sort of allocation they're getting as advisors. If they're getting 5% and they're putting in an hour every 3 months, I'm going to want to understand why. The cap table, current and projected, who the current shareholders are, any sort of warrants, options, the dates, and the vesting, just so I can see what the numbers are going to look like. I want to know that you as founders are going to have enough skin in the game to be to have an incentive to work really, really hard. If after a round you're left with 10% of the company and you're not really making a big salary, how hard are you really going to work? It's going to be easy to walk away. So I want to know that you have a financial motivation to stick around. I mean, we all do things for good reasons, but we all hope to make money out of it too, right? Yeah. So, unless you're in ed tech, I'm just kidding, Brad. Poor guy, I just met him earlier. I want to know if there are any other agreements or restrictions. I want to see the convertible notes or the safe notes. And the reason why I want to see these, especially with the convertibles, I want to see the terms. I want to make sure that those actually convert. And it's not a matter of the first $250,000 of whatever the raise is going to go to pay them off. Because then I know that there's that much less capital that's going to be available for you to scale your company. And I just need to understand that. These aren't necessarily deal breakers, I just need to understand. And if you have a regulatory thing, I want to understand what the budget and timeline is, once again, so I can sanity check it. Let's see. There was a situation where I saw a financial statement where their liability was increasing period after period because I was able to see their quarterly financials for a period of time. And I was concerned in this particular case too that the raise was going to pay for that liability and not to scale the company. And so I just needed to understand that as well. Okay, fast enough for you? There's a lot of stuff I can look at. But once again, sometimes I just write a check, I don't really look at anything. It's like, all in. Corporate and org documents. This one's really interesting. I had a particular startup where I was looking at their documents, and they were an LLC, and they were a different name, and then they were another name, and they were a Delaware Corp. And so what I found through the corporate docs and asking questions, because they went through Women's Startup Lab, and one of the first things they told her is you need to incorporate in Delaware and not be an LLC. And it made it more attractive for investors to invest in. But the organizational docs told the story, so I was able to understand from that what the story was. I want to know the founders in the current relationship. If there is a founder who is no longer a founder and they own 50% of the company, that's potentially going to be a problem moving forward. And I'd like to understand that relationship before I invest. I want to see officers, employees, the percentage of time allocated to the company. You guys are raising $3 million and you're putting in 5% of the time, your time to the company. I have a little bit of concern about that. Any sort of facility leases or any sort of agreements, because I really just want to understand the organization, the legal structure, and any sort of, with the financial, any sort of, what the financial state of the company is now and moving forward to make sure that I'm not putting my money into a money pit. IP and technology. I'm not going to spend a ton of time on this, only because I would want to see patents. Once again, this is not really my area of expertise. And aside from sandstone diagnostic, most of what I invest in, the companies have to create moats. They don't necessarily have defendable IP. And it's a preference type thing. If I see something, I will send it over to my attorney, assuming that it's going to make a difference with my decision. If it's not, I'm not going to send it over to my attorney. But the license agreements, I want to understand the arrangement. I want to know if on the slide deck you put out that you have your global addressable market is this, but per the licensing agreement, you only have access to the US market. That's a disconnect, and I'm going to want to understand why. Because I'm going to feel misled. You said there's this huge market opportunity, but you can only go after this big. So I want to be able to take a look at that. The proprietary and invention agreements, how many of you make an effort to get anybody who does anything to sign proprietary and invention agreements? Okay, good. If you're not, I would take a look at this. Because of one of my investments last year, I am by no means an expert. I learn on every single deal that I do. She had those, and we talked about it. She's a healthcare attorney. She made sure her T's were crossed and her I's were dotted and everything was covered. The last thing an investor, and I think for the venture deals class, I think Brad was saying something about VCs and maybe Ha, and you might be able to speak to this, but VCs are going to look for those signed agreements to make sure that there's no potential exposure later on if the company gets big and somebody comes after and says, that's my IP. So I don't know if that's on your list or not, but it is now something that I look for with every one of my startups, and something that I would recommend looking at. In addition to the Angel book, the Venture Deals book is a great resource, just to let you know. Once again, I am learning every single day. And if somebody says they're an expert in this, things are changing every single day, so it's really hard to be an expert, I think, even if you've been in it in a really long time. Okay, we're almost done. Product marketing and sales. So I want to know what your products are, what your vision is for the various different products. I want to understand if you have major customers, who they are. I may do a reference check on them to make sure they're actually customers. I will do pre-revenue, so in some cases I won't check, because the customers exist. I want to understand the planned distribution channels, any agreements that you have in place, so they can sanity check against how you plan to generate revenue. I want to double check that you're understanding the competition. I'll see a competition slide in the pitch deck, but I'd like to see a more detailed analysis of who the competitors are. There's usually more in the due diligence documentation than there is on the slide deck to show how you are better, how you're going to win, and why they're not going to. Another thing is major suppliers or software developers. I want to understand the risk around it, especially if there's geopolitical risk. You're doing development in Minsk or Russia or some other Venezuela where there's some sort of instability. I want to understand that and understand if there's a backup plan in the event that something goes sideways. I think Stu brought it up on a deal recently because the development was being done in India, and I think there's been some problems associated with getting code over here from India. I don't know if I'm mischaracterizing it just a little bit. And so he had concerns about the development all being done in India. Well, they're actually going to use the money to move the code over to get it to have development onshore rather than offshore. But it's something to pay attention to. Also, single sourcing. There's only one supplier and something happens, I want to know what the backup plan is, if there's a backup plan, and then if that supplier, I want to know the financial stability and the general stability of that supplier, because that could potentially be a major problem for your ability to deliver your product. Last thing you want is to have one of your suppliers cause a problem for you. Okay, and also understand R&D projects, timelines, and budgets. Is it a one-hit wonder, or are you going to, is there something else that you're thinking about? I should know that from the pitch deck, but I'll dive into greater detail on that. So what will the investor do with the information? Well, once again, it depends. Some of them will review it, some of them won't, some of them won't. I will take a look. If I've asked for something, I will generally review it, because the last thing I want to do is waste a founder's time. I appreciate your time is precious. Mine is too. Already talked about that. Check references. Sometimes you'll check a box and move on if you're an investor. And once again, I'll wait until I have everything. I'll sit down with a bottle of wine. I'll go through. I'll send questions. The hardest thing for me, especially with my schedule, is if I don't get a response back for a week and it's piecemeal. So it's the start-stop that is incredibly painful for me, and so I allocate a certain amount of time. So if I don't have responses back and I'm not able to get back to it, it makes it really hard, because then if I miss that window, then it could be another couple of weeks, and so it's really it's hard. So timely responses, I cannot emphasize enough, and thorough responses. If you don't understand what they're asking for, ask for clarity. The last thing you want to do is answer something, and this frustrates me. Are we better? Yeah. We're all good, Pim? So there was a startup that I was advising, and then an investor was asking questions, and he didn't understand it. He's like, oh, I'm just going to pull this together. And I said, but if that's not what they want, you're just going to piss them off, or you're going to frustrate them. You may as well ask for clarification and give them exactly what you want. You're to say, hey, I think this is what you want, but I want to make sure, so that I don't waste your time, that this is what you're asking for. And I don't think you look like an idiot, and I don't think you look dumb. And in fact, I think you look good from a communication perspective. So if you don't understand it, clarify. Let's see. I will do a Google search. I will do a LinkedIn search. Sometimes I'll do a background check just to make sure that there's nothing really wonky going on, or I'll reach out to colleagues, founders, or other investors to see if they know anything about it. Chances are, if I'm in the due diligence phase, I've already had multiple conversations, and they were probably referred to me through somebody that I knew and trusted. So there shouldn't be any surprises, but sometimes I like to do a double check on that. And let's see. What about you? How many of you do diligence on your investors? Good job. Because not all money is that was not condescending, by the way. I'm really glad to see that. Not all investors are who they pretend to be or who they present to be. I think there are a lot of wannabes in this space, and I just hate to see anybody taken advantage of. Most people are good players. But in terms of your due diligence, ask other founders. Ask founders in the portfolio. Ask founders whose companies went sideways how the investors were. Because it's easy to be a good investor or a good partner when things are going well. When things go sideways, it's harder. So understand what they're going to do. Are they going to roll up their sleeves and help you, or are they just going to throw you under the bus? Understand. Then you can choose what to do. I mean, for female founders and for minority founders, it's often harder to get access to capital. And as such, you play the, well, if I don't do this, there's nothing else. You just have to know what it is that you're dealing with. With that being said, I strongly recommend doing some sort of a search if you are a woman on the Me Too type stuff, and see if there are any like Justin Kalbachs out there or any bad players out there. Understand, and I would stay away, but that's just me. I think you can find a lot from Crunchbase, which you can get access to for free. See who else they've invested in, how many investments, have they led. You can do Google searches, you can look at Twitter. Some people are just all out there, and it's easy to find information.
How about PitchBook?
Yeah, PitchBook, but is PitchBook for free? No, see, that's the thing, is as founders, unless you can get access, so PitchBook would be great, and Crunchbase has non-free type stuff, but the last time I looked at PitchBook and Crunchbase for Sandhill, it was upwards of 50 grand a year. It was not inexpensive. I would not expect a founder to be spending $50,000 a year on PitchBook. In fact, I would question sanity. So unless you have access to somebody who's willing to give it to you, then absolutely use something like that. Yeah. And then let me know who it is so I can use theirs. And I talked about it's good to understand who it is, because it's really difficult and expensive to get rid of a bad investor. So just know that going in. I have a founder who's struggling between taking the money with some terms she doesn't love and just being done with it, knowing that there's a small chance that something could get triggered, versus going out and trying to find a new lead. And so I think she's moving forward. So what do you do next? If you haven't already prepared your deal room, I would go create one. All of this stuff would seem absolutely overwhelming if you have to go create it all from scratch. Once again, I have a Medium post, and you can get the checklist, so it's all out there. I also have episode 56 of my podcast. I talk about this too, so if you didn't get enough, you can have more of it. I sit and talk with my producer about this. Start populating it, create the shell, and start populating it with the static documents, like your bylaws and your articles of incorporation, last year financial statements, last year tax returns, your resumes, your accountant information, your attorney information, some of your patent information, list of patent, some of the stuff that doesn't really change, that's fairly stagnant, just start populating it in there. And what you'll find over time is that you'll have requests from investors, and then you just build based on that. And I have found that when a founder comes to me, like I'll say, hey, here's my checklist, and they'll say, hey, here, we have our deal room pulled together, it's structured a little bit differently. Are you okay with this, or do you need me to structure this differently? I'll say, oh, I'll try to work with it. Once again, because I don't want the founder to have to spend more time on something to satisfy my needs. I may be unusual, and there may be other investors, I don't know what you guys do if you say, hey, here's our structure, meet it. but she's a VC and I'm an angel investor. Just take a look at the size of the check and then measure how much effort you want to do on that. And I may be saying things that are unpopular, which is not uncommon. And that's it. Questions? Is that fast enough, huh?
That was good. So we have a lot of time for Q&A.
Okay.
Q&A?
Stu, do I try? I don't know. Okay. Go ahead. I reserve the right to not answer your question.
You were fantastic.
Stu, but you're a plant.
Would you mind if I added to your talk for a couple minutes?
You have 1 minute and you can do it from there.
Okay, so I'm a tech guy. I read source code, and I get called in. People are ready to write a $1 or $2 or $3 million check. They're all ready to write, but they've got some questions. So they'll send me in with a bunch of the same thing you did. Let me tell you about IT. This is where I tell startups, your employees come and go, but your IP stays with you. That's the importance of it to someone looking at your company. 2, I will go in and read code. And I'm great at that, and I'll go looking it through the history of comments that people have left and what repairs have been done. I'll see for telltale signs whether they know what they're doing. I'll look to see that the language is a common language as opposed to something that only programmers were north of the North Pole. You need comfort that, there's in case you walk out the door, other people are around. I did one due diligence. I was sent to New Zealand to check on a company. That was going to be acquired. And then a client server system. They go to 2 terminals next to each other, and I do the same retrievals on both terminals, and I get different results. Stuff like that, they should have known about.
They being the founders, or they being the founders should have known that they're developers.
That their product was not in the state ready to be. It was so easy to trick them.
Yeah. So thank you on that.
That sort of thing.
Thanks, Stu.
You did great.
Well, thank you. But that's good. I already said. I mean, that's not an area I spend any time.
One war story you brought up about the software that's done overseas, which is fine. That's part of life. In one case, I was working on, the company got carried away with the low cost of overseas software development, and then they said, gee, for $10,000 a month, we can get 30 programmers in Pakistan. Very nice until one guy got blown up.
He got blown up?
Blown up.
Oh. Okay, that wasn't quite the story I expected. So, thank you, Stu. I appreciate that.
That is bottle one.
Yeah, in 3 months. So, any other questions? Yeah.
So as an early investor, why do you typically prefer convertible debt over a safe note, or how do you think about the two?
Okay, so if I'm going to do a note, it's going to be convertible. If it is a price round, if the raise is over $1.5 million, the valuation's over 5 or 6, I'm now looking for a price round. So Series Seeds are like 25 grand. At that amount, I want to know how much I own. So the way that I understand it, safes are neither debt nor equity. They're just so much. There's so much ambiguity with safes. Safes, it's rolling, so people can have different terms as it's being raised. And as the first investor in, I'd like to know that we all have the same terms. I don't want to know that somebody else coming in is going to have completely different terms because they came in because it's a rolling thing. So they're just a couple of things that I just prefer and I'm more comfortable. Zoom, I actually invested in as a safe, and it converted, and I think it converted when Sequoia took their Series A 1.5 years ago. But other than that, it's just they also claim, so YC put them in place, if I understand it correctly, in order to make it easier for founders. But I'm not sure that founders really have any greater clarity as a result of it. So I generally prefer a convertible, or if it's over $1.5 million raise, I look for a price round. Is that close enough?
Yeah.
Okay. There was a question over here. Oh, yeah.
When you've seen deals get syndicated, how has it affected the timeline and the level of due diligence to the syndication process?
So I haven't invested in any syndicates on Angel. Now, when you're talking about, are you talking about AngelList, or you're just talking about syndicates like somebody pulling together a group of people, a party round type thing?
From
So, I mean, if you're talking about, let's say, an angel group who's syndicating together, I am not a huge fan. Anybody in here in any angel groups? You are. What are you in? Oh, angel. Oh, you're in angel. AngelList is a little weird. It's so like Sandhill Angels. So I recently joined Wharton only because it was like $250, and I can now funnel all of my deals to brand new investors and train them the way that I want them to be trained. So, yeah, this is recorded and put out there. I'm infiltrating. So I have the opportunity. So with Sandhill, it was like a 3 to 6 month process to get all the investors, and for a check that was somewhere between, on average, like $50,000 to $75,000. And I think that is way too long, and I think it's way too much for the founders in terms of the hoops that you have to go through. And depending upon the deal lead determines how much due diligence is going to be done. And I think that, once again, I don't think that's very founder friendly. Where we are in the Silicon Valley is what used to be a Series A is now a pre-seed, seed, post-seed, somewhere in that mucky mess. And so you've got all of these early stage VCs who've moved down into a place where we angels used to play. And we probably could have gotten reasonable deals and whatever. You now see a lot of angels as wannabe VCs who are now putting more structure into place on their investments, and they're still only writing checks for $10,000 to $25,000. So I'm not really answering your question, but I'm kind of complaining about the fact that we angels need to move further upstream and somehow fill the gap between the 50 to 100,000 friends and family and these $1.5 million typical pre-seed, seed, post-seed. I mean, I'm seeing 2, I'm seeing 3 on $7 to $12 million pre's. I mean, these are Series A, old school Series A investments. So there's a huge opportunity in this space. And then the risk is higher, but the valuation should be lower. And therefore, I would expect that less due diligence will be done if we're not wannabe VCs in this space going after these kind of things. So I think in some cases, hold on just a second, unless you're going to correct me or add to it, but the syndicating that I've seen is within angel groups. I get emails about deals where somebody's putting together an SPV. I mean, I got one today trying to pull that together. I don't know what level of due diligence they would do. I haven't really been a party to those. The investing that I've been done has been very direct because I got tired of being held to 3 investors, $50,000 through Sandhill, so I'm only going directly right now. So I don't really know. I kind of know, and I don't like where we are right now. Yeah.
A question about deal rooms and the risk of oversharing.
Mm-hmm. Yeah.
You put together a deal room with stuff you think you want the investors to know. You add to it as investors ask you for other stuff. Does that then become an internal resource where you only give investors, later possible investors, stuff they've asked for? Or do you make the whole thing available to any reasonably serious investor who asks and run the risk that you've given them something that raises a question that they didn't necessarily have?
I think it has to do with how you want to play that and how you want to manage it. Because doing it in a way, if somebody says, hey, do you have a deal room? And you could ask, well, what would you like to, we've got various different things available. What would you like to see? I don't want to overwhelm you with stuff that's not of interest. And they can say, well, we want these things. And you can say, okay, then you put that together, holding other stuff there. But that means you're managing multiple deal rooms based on that. But then if you're really concerned about all of your information being out, this is the way that I would potentially do it. I would start by, okay, you have a choice. You can have all of it or just some of it, and here's what it is. And then if they start asking more questions, you can say, hey, I've got a full deal room with all of this. Do you want just access to that? They may go, well, why didn't you give me access to that to begin with? And she's like, well, I was just kind of trying to save you the headache. I think there's a way to kind of talk around that. So you, depending upon what your startup is, what your proprietary stuff is, what you're concerned about, who the investors are, you're going to have a sense of how you want to play it. I don't believe there is ever a one-size-fits-all for anything. So, but remember, this is my opinion. Yeah, back there.
Can the founder and the investor share the same attorney manager?
Share the same account? Oh, the attorney? I don't think it's generally recommended that you do that. I don't think I'd ever feel comfortable because how do I know who is more important to the attorney?
I don't think the attorneys would go for that themselves.
I don't think you can do
Okay, I don't know about, I'm not a lawyer. I play one on TV, so I don't, you can't do that? Thank you. I don't know.
I've heard of it in other countries, but never.
I mean, because you've heard of real estate agents sharing, so generally somebody loses. So I don't know the answer to that. But in general principle, I would not feel comfortable with that. Because then who pays? No, it just goes down a hole. I just wouldn't want to be. You're just learning? Oh, okay. So I didn't mean to be dismissive with that answer at all. I would not personally feel comfortable knowing that the person I paid was not 100% in my court. Yeah.
So beyond the Brad Feld and Jason Mendelson class that you had seen online, any other recommendations on things that you've seen online or things that you've done, classes that you've taken in the past?
So Carol Sands does a class down at Stanford that I heard is, you're talking about for investing or for founders? Which are you talking about?
For founders.
Oh, for founders. So it's interesting. On my when I was, where was I? Was it Founders Institute or Women's Startup? I don't know where I was speaking. Somebody asked me for founder resources, and I was at a complete loss. So now every time I interview a founder, I ask them what their favorite resource is, and I'm putting together a blog post on that to make them available. I already have a blog post out on investing in angel investing resources. Including newsletters, everything from, I get Brad Feld's daily, I get Fred Wilson's daily, I get Morning Brew, PitchBook, Crunchbase, TechCrunch, Inside, Strictly VC, that's another one I started. So I have a whole list on there, and then I've got some of the digital health ones that I follow as well. Remember, this is a part-time thing, but I can't seem to keep up. But there might be something on there as well that might be a good resource. But if anybody's interested in investing, apparently Carol Sands' class down at Stanford is supposed to be good. I've not taken it. I jumped in. I learned by doing more than I do by taking classes. Yeah, I'm sorry, I didn't see her.
It's really helpful. And I just want to ask, do you use AngelList to look for new investments? If you do, what's your experience in using AngelList? If not, where do you look for new investments?
Okay, so no, I don't look to AngelList for new investments. I find the platform to be clunky, not user-friendly, and I struggle with it even with the new dashboard. I also don't know everybody on AngelList, and so in terms of my deal flow, so the last 3 years I have been connecting and networking like crazy, and so I go to events. I have people from around the world who send me deals. The best way to get something into me is through a warm intro. Sending me a note on LinkedIn saying, hey, I have this great idea. Can we get together for coffee? Without any sort of context or warm intro is the fastest way to get deleted from the LinkedIn request for me. It used to be I was much more open, but now I have to be incredibly discriminating about my time. I have my solutions to projects work, my expert witness work, my blog, my podcast. I advise about a dozen startups and then a number of random ones over time, and then my investing. And then I have a husband, 2 kids. It's just, so warm intros are usually the best way through somebody or through various different events. So, and every investor is going to have different ways of handling getting their deal flow. I'm like, I used to get a lot of it through Sandhill Angels. I now get none of it through Sandhill Angels. Some of it I will funnel through if there's a specific request. But as I said, the timeline's too long and the check's too small, and it's too arbitrary in terms of who gets funded and who doesn't get funded, which I find incredibly frustrating, and I would think would be even more frustrating for a founder. So I'm a little bit down on angel groups. Yeah.
For an entrepreneur, what would be what's the value proposition for going to angels and sort of investing from angels versus going directly to a seed or through an incubator or something like that? If the money wasn't sort of the main thing, you mentioned like networks and sort of value other than the
Oh, I don't think there's any downside of going to angels from the very beginning. Especially if you find ones who can provide you with more than just the check, who can provide you with access to customers, potential customers, or access to other resources. One of the startups that I advised through Tech Futures Group, they were raising a certain amount. They identified this angel, and she really pushed back on the valuation, but she was willing to put in a certain amount. She was willing to lead the deal. And they really struggled to begin with until they realized that every portfolio company of theirs, she had poured in a ton of money into. So the initial check and the initial pushback was laying the foundation for follow-on. And so they ended up being very, very happy going with that particular angel and then raising money from other angels. They had no institutional investors. I think they were doing 1 or 1.5. Ended up being on a $4 or $5 million, I think like a $4 million valuation, and it was all from angels. So there's nothing wrong with going directly, especially if it's early stage. There's nothing. Well, you have to manage those relationships, you have to manage your cap table, all of that, and just think through, depending upon how much they're in, what sort of, But in the agreement, hopefully you've got information rights set in there, you've got pro rata set in there, you've got certain terms that are set in there, so you can effectively control and manage those relationships legally to make it so that you can then leverage, and I say exploit in a very positive way, exploit their networks and the positive value adds they can give beyond just the check. But some people will just write checks and they are going to be quiet and they're going to walk away, and somebody wants to give you $250,000 that way, I don't think I'd walk away from that. But, and admittedly, I've never raised money. I've only invested money. I've had my consulting company, but I self-funded that, and, I did that on my own. And somebody argued that I'm not an entrepreneur because I'm a consultant. I'm like, do you know what it takes to run a successful consulting company with contractors and everything else for 13 years? Yeah, no, I'm not going to argue with you on that. I'm going to argue with you on that one. Did I answer your question effectively about earlier? Because Yeah, I don't, unfortunately, I just don't have anything else. Is it nothing?
I have a question.
Yeah.
So
Is it one I'm going to be able to answer or not be able to answer?
Yeah, this is partially perspective.
Okay, thank you.
My question is basically like from hearing you speak, so confirm if I got it right, and then maybe you could expand. It seemed like you were very focused on building you were able to focus your activity or interactions with the founder to build the relationship versus testing them?
I do, like in my due diligence process?
Yeah.
I mean,
and then it kind of goes back to something you mentioned when you were answering questions about, you said it could take 6 months to get 50 to 75 grand asking questions and doing all this stuff. Doesn't that hurt your competitiveness?
Okay. So we're combining two things. So we're combining two things.
I would think the competitiveness is hurt by too much testing.
Yeah. So in terms of the due diligence that I do, generally I am sanity checking. I'm not testing. I personally am not testing the founder. Others might be, but that's not what it is that I'm doing. I'm looking to support the decision that I've made. I'm not looking to kill it, and I would be really, really sad if I stumbled into something that would make me not invest after I'd invested that amount of time with it. So it is about building the relationship, better understanding the business, and understanding how I'm going to be able to provide value beyond my check. Now, what you were talking about is with angel groups. Angel groups take a long time because of the way that they're structured. Usually they have, you submit through ProCedar or through Gust, and then they get together on a monthly basis, and then they decide who to come in for a dinner, and then they decide what the next step is, and then they start due diligence, and then before you know it, 6 months have gone by. So that's what I'm talking about with angel groups, and that tends to be fairly typical. It's a 3 to 6 month process. And depending upon the angel group, like Life Science Angels claims that they write $250,000 checks. I don't know how many of those they actually do. but that means that either 10 of their investors put in $25,000 each. So then you've got 10 people with different agendas trying to get on the same page to then get to consensus to make that final investment. So that's a thing that ends up taking a while because a lot of the angel investors are not doing it full time. They don't necessarily have a ton of experience. A lot of them may be following somebody else, and then maybe the deal lead is trying to talk other members into it, and that takes a while because getting a hold of them and the follow-up and everything else. So that tends to extend the timelines within angel groups. So my perspective with angel groups is that the value from a competitive perspective, because now we have so many VCs focused on this early stage, pre-seed, seed, post-seed, blah, blah, blah. You have so many VCs in there and there's a lot more money in there. If you have a choice between going to one of those and getting a larger check versus trying to play the angel group game, I'd go after the early stage VC. The bar might be higher, there might be other strings that get attached, but if you're going to spend 18 months trying to raise $1.5 million versus you can do it in a 6-month period, sometimes you just need the money to go. Why slow things down? Because we know slowing things down, you're just going to have a harder time getting to market, gaining the competitive advantage, depending upon what it is that you're in. So our model right now is, I think, a little bit broken, but it's here in the Silicon Valley. I'm not necessarily seeing the same thing. I mean, the Series A I just invested in she was raising $1.5 million on a 5.5 pre. That's a Series A. The other one was the same thing. We see pre-seeds like that now here in the Valley. So, yeah.
What's your average time that you spend on due diligence? You talk about sort of the shortened window.
So a start day, I think I probably did 2 weeks just because I was traveling. Send a ride took me longer because I was doing a lot more because I was trying to syndicate it and I felt like I had a fiduciary responsibility. As I said, my health teams I did 0, Tomboy X I did 0, Sandstone I did 0, Zoom I did 0. I just said I'm writing checks. So I would say 0 to 2 months. And the only reason I say 2 months is I sat down and then it took a while to get the information to come back. But so I would say I will make a decision. Like Laura in Send a Ride in January when I got on the phone with her afterwards, I'm writing a check. And I asked her, I said, I want to syndicate my first deal on AngelList. Can I practice on you? Can I use you as a guinea pig? And hopefully that's going to close, not because of me, hopefully that'll close this week. So, yeah.
Do you have any experience with private equity following on your investments and your thoughts on that?
Not yet. So 3 years in, so Zoom just raised a $19 million Series B. My health teams I invested in at B and C. And the only reason I got into that is because Sandhill had invested earlier. Tomboy X just raised their A. Sandstone is still on their A. Astarte is their A. So no one's there yet. Tomboy X might be because it's an apparel company, but I actually expected that they would have been acquired, but they're doing such a brilliant brand play right now that I don't know where they're going to go right now. So, but no, and I have no experience. I mean, that's an area that I need to better understand because one of the other things is female founders have and it's one of my areas, female founders have a hard time getting traditional VC funding. And so trying to work with a whole bunch of people to figure out what an alternative funding ecosystem looks like, where that money comes from, what that looks like, so that it's favorable and not punitive. And until we can create significant FOMO for the traditional male VCs to come over into the space, like Katrina Lake with Stitch Fix is a brilliant example of she's a great example of doing more with less and a great success, but we need more of those so that more male investors will invest in things that they can't relate to. So
we'll
you have a question?
2 more questions.
Okay. Doctor.
Knowing what you know today after 3 years of angel investing, what would you do different if you had to go back and start all over?
That was interesting. I talked to my executive coach. She's tormented by the fact that I was tortured through my Sandhill Angels experience, but I gave it 2 years and I learned a ton. What would I do differently? Find a way to have more money at the beginning to invest. So I don't think I would have. I'm a rose-colored glasses, especially in hindsight. So I don't think I would have done anything differently. You know what I would have done? I would have appreciated the value that I brought to the table from day one, rather than questioning it for a year and a half, 2 years. Because when I applied to Sand Hill Angels, the membership guy, who was an old white guy like my dad, said, "I don't think the board's going to approve your application." And I asked him why, and he said, "Because you don't fit the typical profile." I didn't have the confidence to say, "Well, what's the typical profile?" And so when I jumped in September of 2015, I thought I had to prove myself. Well, that did not go over very well with a lot of these guys who were already threatened and intimidated by someone like me coming in and disrupting the status quo. But what it did is it drove me to learn and work hard, and I learned more in that 2 years, which I call my real-life PhD, than I think most people learn in 2 years. I didn't go take classes. If I'd gone to Carol Sand's class, there are a lot of women who learn about it but never actually do it because they get afraid of it. Kind of like when I learned how to scuba dive, it was in Club Med, and I went scuba diving, and I didn't think about it because I didn't know all the things that could go wrong. And then when I went through my certification when I was 25, and then I knew everything, and I'm claustrophobic, I panicked in the water in Monterey because I couldn't see here, because I knew all the things that could go wrong. So for me to jump in, it was the best way for me to do it. And if it had been different, I don't know if I would have learned so much so quickly, but I really wish that I'd appreciated my value and what I brought to the table, and the fact that I was different was my value. Because I look at things completely different from those old white guys. They bring stuff too. I don't hate men. I don't hate old white guys. But there were a lot of people who made my life incredibly difficult, and I wish that I'd stood up for myself more. That's probably it. Do we have one more question?
One more question.
So I don't know if that answered your question the way you wanted it to, because you probably wanted something more academic and less touchy-feely. Yeah.
What kind of helicopter?
Robinson R44. I generally like to fly. It's a 4-seater. Because flying helicopters is my hobby, I try to mitigate risk. And so I always take a flight instructor up. And I love taking passengers and taking them flying for the first time, taking them underneath the Golden Gate Bridge. I love flying over Moffett because I was born in San Francisco, grew up in the East Bay. I've never lived anywhere but the Bay Area. And Moffett used to be a military base that was restricted. So it's so cool to be able to fly over. And the joke is that when we call them and to tell them we're going over, that they have to like put down their donut and brush off, whatever, because nobody ever flies over them or in their airspace. So it's also much more stable than the 22, but I only fly those. It's a hobby. So, well, thank you so much.
Thank you.